In this episode of Net Lease TV, we have a star-studded panel that will be reviewing how the coronavirus is affecting commercial real estate, capital markets, and commercial real estate in general. Our panel includes Chris Marabella, moderator, Alan Fruitman, 1031tax.com, Keith Sturm, Upland Real Estate, Jesse Limon, Marcus Millichap, Carly Iacono, Marcus Millichap, Matt Berres of Newmark Knight Frank, and Michael Lynn of Progressive Real Estate Partners. This is Wednesday, April 22nd, 2020. But before we begin, let's review our timeline again. It all began in December 2019 in Wuhan, China. The coronavirus spread all over the world, affecting capital markets, commercial real estate markets, and the stock market. It began with a supply shock where retailers, manufacturers could not get goods, which created a bottleneck. Then a demand shock when communities throughout the world got shut down. And now it's turning into a credit liquidity shock. In this episode of Net Lease TV, we put together a superstar panel in the net lease market to discuss the impacts of the coronavirus on net lease sales and the finance market this Wednesday, April 22nd, 2020. Have you guys on the panel. Our first question on the panel today, the net lease, what's happening with coronavirus, how it's affecting net lease, the capital markets, is for Carly over at Marcus Millichap, Carly Iacono. So Carly, hey, how are you doing? It's great to see everybody, by the way. What are you seeing as the best? You know, this is going to go in stages with the coronavirus. Right now, we're all kind of locked down. And then I think it'll go to another stage where some of the businesses will start to open, but everybody will still be, cautionary. And, it'll still be on everybody's mind, the coronavirus. And then at some point, hopefully, if we don't have a second wave, things will somewhat come back to normal. So in stage 1, 2, and 3, what do you think are going to be, before the coronavirus, what were the best uses? What were the uses that all the investors were saying these are kind of the darlings of the investment world?
So there's definitely been a shift to quality and security. And quality and security right now equates to which tenants are paying rent. So the investor sentiment is very, very bullish on grocery, convenience, and drugstores, because those are the tenants that are open, they're operating, they're doing well, and we don't think there'll be a lot of long-term negative impact from the coronavirus. So definitely strong demand in those sectors. Not to say things like fast food, which were, of course, exceptionally popular 2 months ago, are not getting done. They still are, but it's much more difficult and it requires some creative deal structuring. And I think you and I had spoken previously that we just closed a KFC in Texas. We have another Taco Bell under contract. So those types of deals do still have long-term value to investors because of the drive-through and the rent increases and some things about the type of tenant and deal long-term. But in the short term, there are obvious challenges.
Yeah, but I mean, you got to look at this on a long-term basis. Yes, the coronavirus may be with us maybe a year, but in the long run, I don't think people are going to stop going to McDonald's. They're going to stop going to KFC. People are still going to want to go to fast food wherever they go, be it Las Vegas, here in San Diego. So I think that the existing landlords stay pat. And if they're in this for the long run, they're going to be just fine. And new people that are looking to enter the market, maybe this is a good time to start to look at some of those deals. Would you agree? It's kind of a good time to, get involved and start analyzing fast food deals.
Absolutely. I think as long as you can get comfortable with the rent, maybe you do a rent escrow for a few months, you really are careful with how you're structuring the deal in the short term, the long-term viability, I think, is very strong, especially for deals with very large guarantors, well-positioned, signalized corners with rent increases, like I mentioned in the term, in the drive-through. The drive-through is very much key for long-term intrinsic value.
So this is for both you and Michael Lynn, because I know Michael wanted to chime in. Do you think the pharmacies, now the pharmacies, you know, there was always a little bit of trepidation with Amazon that they could be disrupted, but, you know, now the pharmacies are in a unique position to capitalize on being very convenient. I mean, I know if I'm, right now, if I had to go to the doctor and go to Scripps, I'll bet you it's 3 weeks to a month just to see a doctor. If the pharmacies can, you know, take advantage of that and be not only a pharmacy, but almost like a clinic, that could be huge. I think that's going to bring the pharmacies back in vogue again. Would you guys agree with that? I'll let Michael answer and then Carly.
Sure. Yeah, I do. I think that this whole pandemic has really brought health to the forefront of people's minds for the reasons that you mentioned, and also just to bring the top of mind that the pharmacy is providing a very important service. And of course, there is that clinic component to it. There is picking up your medicine, and also, you know, a lot of them do have your groceries and your paper goods that people have been needing over the past couple of months. So yeah, sure, I think this would definitely help the big drugstores out there, CVS, Walgreens, Rite Aid.
And I think, Chris, I'll kind of chime in. From an investment perspective, the fact that CVS and Walgreens are such strong companies, they're investment grade credit, that is definitely a focus right now for investors, as I mentioned, is this flight to security and quality. So not only, like Mike mentioned, is the business at the forefront of everyone's mind, but I think the actual strength of the companies and that lease guarantee is paramount right now.
And the dollar stores, what do you guys think of the Dollar Generals? I know they're doing 900 stores a year. Is that still going to be a growth area for investors? Carly or Michael?
I do.
Sure. Yeah.
Go ahead, Carly.
I'll just comment quickly. I think dollar stores are very well positioned because they have such great market coverage. They are meeting the consumers where they are in their local towns and their markets. They do provide convenient, smaller footprint shopping, which is what people want. And in a recession, obviously they fare very well, which looks like we are unfortunately headed towards. So not only is it value, it's convenience. Both pieces are important right now. And then you do again have that investment grade guarantee on both Dollar General, Family Dollar, and Dollar Tree.
Awesome. So does anybody else want to chime in? The only thing, I'll just say one thing. I'll say, yesterday I did go to CVS, and I'll tell you what I bought. I bought shaving blades, shaving cream, and some other things. But, you know, before we'd go load up at Costco, right? We'd go to Costco with spend $300-400, buy the toilet paper, buy the paper towels, and maybe even buy those kind of things. But now our CVS is right here. So we're just shopping right here in our area that's convenient. It's right here. Did anybody else want to add anything on this question?
Yeah, Chris, could I just add something? You're asking about, you know, what was in vogue before and during and after. Yeah. And I think one thing that's ironic about what's going on is, you know, for the past couple of years, up until about a month ago, you know, everyone in retail was talking about, you know, experiential retail and the F's, food, fitness, and fun, and that was the future of retail. And right now, those are the businesses that are suffering the most, and they're going to be the ones that are going to have to dig themselves out of the biggest hole. I think right now, some businesses that we don't think about that are doing well are bike shops, automotive related. I think people have time to work on their cars right now. But I think coming out of the pandemic, you know, medical and dental tenants, those are going to be taking, I think, some shopping center space. And the ones that bounce back will be the ones that will provide the goods and services that won't require us to be too close to each other. So I hope that everyone wants to go and work out again and go out and eat at restaurants again. But I think
we're all gaining a little bit of weight, huh? And my hair, what I have left is getting longer. I think there'll be a long line. The one thing I want to invest in when this is all over is maybe supercuts. Are they public? Because there's going to be a long line. We're all going to want to get our haircuts.
Yeah, for sure. But
I know in Wuhan, I saw some of the videos, and they had a whole line of people. Once it opened up, people were trying to get their hair cut, believe it or not.
Yeah.
So let's trans on. Oh, go ahead, Keith. Do you have a statement? Oh, there's Keith Sturm. Hey, Keith, what's up?
I'm the oldest guy here, so, you know, I'm technologically challenged, right?
Yeah.
I would just like to add with regard to what Carly was saying about the Dollar Generals and Family Dollars. We actually are coming out with a brand new package of those today. Should be hitting the market anytime. 7 new properties that we decided with our client to say, hey, now's the time to be selling these types of properties for what Mike and Carly were saying for sure. It is the time of the dollar store. There's low costs, good credit, easy to purchase with not a lot of brain damage. So folks are moving that direction, and hopefully these 7 properties we just put on the market will have some action on. Our very last property, I think I heard earlier, Matt was saying that we did put that one under contract actually today. So hopefully that one gets to a closing too. So the market is active on dollar stores, absolutely, and I see them for sale every day.
Mm-hmm. What's the cap rates that your list cap rates right now, Keith? About?
Well, these are kind of opportunity properties. They are older leases, right? So the lease terms are shorter terms. What's that?
They're shorter leases?
The shorter lease terms. So instead of being at, around that 6 to 7 caps, these will be starting off at, that 6.8 to 7.5 cap range, depending upon the term and location. But these properties, we didn't have we did have these on the market previously, and we didn't get a lot of buyers at those cap rates. But with the T-bill or the T-bond at around 6 to 7, Chris, you probably know that number better than anybody here. People are looking at those pretty good returns. What is it? What is it today?
We said, as we talked yesterday, before we had this event, we were talking a little bit. There's really going to be a disintermediation when you can only, for a while there, before all this, you were looking at what, 2.5 at best in the bank. Now you're maybe down to 0 to 0.5. I don't know, but if I'm an investor, I'm going to disintermediate. If I can go into a net lease deal and get 4 to 6%, 7%, that's an awesome return over. And so before it was kind of risk off. You could go into the bank, you maybe could get 2.5%. Now I think it's going to be risk on, but there's really no other place that you can get those kind of returns. I don't think you can get that in corporate bonds, muni bonds, and you've got a tangible asset with the net lease, right, guys? And you qualify for the 1031, which is great. I want to transition to Alan. Mr. Fruitman, are you alive over there, buddy?
I'm here, Chris. Good afternoon.
So Alan and I have had a long track record. Keith and I, some of the other ones, we haven't done deals, but I want to do deals. Fruitman, tell us, are most of your buyers wanting financing at this point? Let's say stage 1, 2, and 3 again. Are they doing all cash deals? Do you think that they'll want to do financing? What's your read on that? Are buyers going to want to do all cash just because they can't get return in the bank, and maybe they'll buy smaller deals all cash, or do you think they'll go for larger deals? Give us some feeling of where your buyers you think will come in at.
All right. So specifically under LOI or contract, I have a CVS, a Wawa, 7-Eleven, 2 Burger Kings, and McDonald's, and Raising Cane's under LOI or contract, and only one has a loan. I think right now, if an investor has the luxury of paying cash, I think they are. And the old days, when the market was very strong, people would say, okay, I have a $4 million exchange, or whatever the dollar amount. Should I pay cash, or should I leverage and maybe buy 2 properties at 50% leverage, or diversify? They used to diversify more, but I think right now people are staying conservative, and if they have the luxury of paying cash, I think they are.
So they're paying cash. That's what you're thinking. Well, yeah. let's look at how many loans are out there right now. From some of my information, there's 4.5 trillion outstanding loans, if you guys can believe that. It's a lot of loans. And one thing that 13 trade groups are doing is they're lobbying to the Federal Reserve and the Treasury to reboot the TALF program. How many of you guys heard of the TALF program? In 2009, when we hit the credit crisis, that was a big deal. TALF. right now, CMBS isn't included in TALF. And so that's a big thing that these 13 trade associations are lobbying for. Commercial real estate is 18% of GDP, so that's a huge number. I think the most important thing for us is we really need to get politically involved. Unless we just, are complete capitalists and just say, hey, the market should be the way the market should be. And if a guy loses, he loses. There'll be a buyer, a buyer, seller, whatever. But if you're on the other camp, and there's going to be a lot of loans that are going to be coming due in the CMBS market. So if you feel that government assistance is a good thing at this point, and the Federal Reserve, then you should get politically involved and write to your senator that yes, they should include CMBS in the TALF program. A couple other things. Right now, the 10-year Treasury, I did look up some statistics. 10-year Treasury as of April 22nd was 0.60. Federal funds rate 0.25. In 2009, the 10-year Treasury was 3.26, and the federal funds rate was 0.16. So we had a lot more room in 2009 for the 10-year Treasury to come down. But, the federal funds rate was pretty low. It was a little bit lower than where it is right now. Jesse, do you have any comments? What are your thoughts on this? Do you think that there should be government intervention? Do you think that, we should go to the Fed and try to get them to buy the paper, the CMBS paper, and try to get the Treasury involved? Or do you think that this is a natural thing in commercial real estate, that there's going to be ups and downs, and just let it go, let it be? Laissez-faire.
Yes and no. I mean, I think that with respect to some of the mom and pop, our core infrastructure, the people that are working and really paying the taxes, and the part of the economy that I think gets skipped oftentimes when the government intervenes is the smaller, mom and pop entities. And so I think that intervention there is fine. And I think companies, larger entities like, Cheesecake Factory receiving money for this, was earmarked for those folks. I mean, I think that's a situation where I'd rather have seen Cheesecake Factory go under if that was, to be the case. As it relates to CMBS debts and intervention there, I mean, I think that we're going to see a lot of loans in default if something isn't done, just because of the fact that we're in quarantine. We're not driving on the interstates. We're not going to our job every day. We're not passing by that high traffic Starbucks that has a loan and debt service attached. And so, that fortunately, like Starbucks, they're paying the rent. I've got one under contract. It's closed, but they're, buyers moving forward on that deal. It's a deal that's more logistical. It's, you would drive past it on your way to work or college or whatever, but it's not a neighborhood location, which they're keeping a lot of the neighborhood locations open. So it's yes and no. I think a lot of the companies out there that are looking for a bailout for the sake of a bailout, they need to see them go away.
Let me just say one more thing on the financing, and then we're going to move on to Matt Berres. Right now, Wells Fargo, first quarter 2020, put away $4 billion in loan loss reserves, and they had a pretty big drop in their net income because of that, most in a decade. JP Morgan put away $11 billion. Some of the causes of that is a lot of large, investors, business owners started to try to get liquid. They saw this coming, so they started to tap into their credit lines, and they all did that all at once. So basically, the Wells Fargos of the world, the JP Morgans started to figure, we better figure in these loan reserves. And the question is, did they do too little or did they do too much? Because later down the line, they can start to get some of that money back, and it won't reduce their earnings as much. But if they overdid it right now, it could really crowd out their lending. And I think that's from my vantage point, I've seen a lot of lenders get stricter. They don't want to do as high LTV. They want reserves. I know that Jesse and I are working on a couple restaurant deals, and that's what I've encountered. The lenders were saying, yeah, before coronavirus, or maybe 3 weeks back, they were saying, we'll do up to 65, 70, 75% loan to value at a 125 minimum debt coverage. Our rates for like a 5, 7, 10 year are in the 3.5 to 4.25. We'll do a 25, 30 year AM. Now they're kind of saying, you know, and I think this is because some of the lenders have gone out. There's less lenders. And so the lenders that are remaining are figuring we can charge a little bit higher interest and be a little more conservative and a little more picky on the deals that we do. So they're all kind of saying, okay, we want to do 50, 65% loan to value, maybe 25 AM. Maybe we'll want some reserves. They're just more conservative. So that's kind of what we're seeing in the financial markets. And if anybody wants to comment on that. No?
So Chris, my question is, you know, I've talked to a number of investors that believe since the Fed's fund rate is at 0%, that they're going to be able to get loans in the, you know, the low 3% range, maybe even lower, and do that for some term. I understand that that's not the case. So if a buyer came to you and said, hey, finance my project, but I would like to get something in the low 3% range, is that a possibility, or is that not?
Like I closed the Bank of America ground lease. I locked at 3 5/8, 7-year fixed, 30-year AM. It was about 3 weeks ago. Started that deal February. At February timeframe, it was possible to get into the mid 3s right here in my backyard, Southern California, Northern California, through some of my lenders. If I go out of state, I would probably in the high 3s, mid 4s. Today, some of those lenders are out of the market. There's just less lenders. It's just supply and demand. And with these reserves, the lenders are getting much more conservative. To give you a metaphor, Keith, it's like you give me some pizza and I start choking, right? And then you say, here, Chris, here's some more pizza. And I'm like, no, I'm choking. I can't have any more. That's where we're at in the cycle. The lenders are already choking. So the lenders that are out there, they figure, well, that guy's choking. I can raise my price for my pizza because he can't sell pizza anymore, or he can't eat pizza. So that's the closest metaphor. That's where we're at in the cycle. There's just less supply of lenders, and the lenders that are out there figure that they want to be a little more conservative. They're thinking maybe there's some loan losses ahead, and they're just kind of, you know, getting defensive at this point. So not to go ahead.
Would you say they've, you know, padded with a risk factor that wasn't there before?
Yes, for sure. In the last 2 weeks,
how many basis points?
It was very sudden too.
How many basis points was it? 25 to 50?
I mean, up to this point, Jesse, like up to the last 2-3 weeks. I mean, if you came to me, we had an outstanding fourth quarter, and you guys all did too. And January, February was a little bit slower, but the lenders were saying, you know, let's do this. Let's, you know, we'll do 3.5-ish, 4% rates. And I would say, really, it started happening when you start to see those huge drops in the stock market. When the stock market went down 1,000 points a couple of days, and I have those days because I did a net lease flash when the stock market was going down, and that was about the time that you know, everybody started sensing. I think that people kind of underestimated the coronavirus. They didn't really think it was going to be as significant as it was, and it was going to hamper all of us. And when that reality started soaking in, that it was a mini panic. And I think that's when the stock market crashed, went down 1,000 points, a couple of those, big days. And that's when the banks started pulling back. I had one lender said that they had committed. I called him because I wanted to see if he was still in the market doing deals. He said, yeah, I committed these deals, and my chairman said, we're not going to honor the commitment, and all these guys are hard. And he asked me, what am I going to tell my borrowers? I feel terrible. And I said, well, hang in there, maybe something will change. So he went back to the chairman. The chairman said, yeah, we'll honor those, but going forward, we're going to be a little more choosy, and our rates are going up. So that's the kind of thing that's going on in the capital markets. They're just basically kind of backpedaling. And we had a Walgreen deal we were trying to do with a major bank. It valued $10 million, 14 years remaining. All I had to do is a $3.1 million loan. And they said, we're just too tied up with the PPP loan program and these loan loss reserves and everything. We're going to be out of the market for a while. So, that would be a slam dunk deal, a $3.1 million loan on a $10 million value. And it was a cash out. And I thought, I would make that loan. It's so conservative. So those are the crazy things going on in the financial markets.
So Krista Allen's point, when he said that out of his number of transactions that he had, there was only one financing component there. Seems to be a trend, I think, in the net lease market. We're seeing that too, that it's difficult to find financing for our borrowers. And if we could get that 3.5% or less with some decent amortization, I think we'd be doing more transactions. At least I know I would. So it's interesting that's been Alan's observation also.
Well, let's think of it. What do you think is going to happen to cap rates? We know you can't get much in the bank, but if there's less financing chasing deals, does that make cap rates go up or down? Or does it just kind of leave them in the same position? Anybody? That's a good question, right?
Yeah, Chris. I think the strong are going to get stronger and the weak are going to get much weaker. There's the McDonald's and the Chick-fil-A's and the strong restaurants with the drive-thrus will remain strong. The dollar stores will remain strong. And cap rates might compress and go down. But if you have an IHOP or a Denny's or an Applebee's or other non-essential, you can't social distance in those, no drive-thrus, I see cap rates rising on those properties.
So that leads to our next question to Matt Berres. Who's going to be buying next? Is it going to be individuals, families, institutional buyers, REITs? What's going to happen to the REITs?
Yeah, I think, well, first off, hello, everyone. Hope everyone's safe and healthy. And I'm happy to be a part of this on my wedding anniversary, too. So, let that go. But,
we don't want your wife to come in and just grab you off the stage here. That wouldn't be good.
Got some nice flowers, nice little presents. We're doing all right. But I'm looking forward to a dinner tonight.
Congratulations.
Did you lock the door so she doesn't come in and just take you away?
Yeah. It's not so much my wife as it is maybe my 3-year-old daughter. I don't need to worry about my 10-week-old son, but it's my 3-year-old daughter that likes to be a part of these. But no, hope everyone's good. This is a great panel. I think as it relates to, who's out there and what's going on from buying activity, I think we all can agree. I mean, the end of, let's call it 2019, another robust year, right? So we topped out, I think it was $78 billion in single tenant net lease. And then a lot of that was spilled over into, the first quarter, right? Everyone continued to have a pretty, robust, pipelines or closings going on in the first quarter. And so I'd include institutions in that. I'd include family offices. I'd include funds. I'd include privates. And then I think as we just saw, let's call it the last 30 days or so, I think we saw a lot of those net lease REITs and the institutions kind of hit the pause button. We've all seen what's happened to their stock prices. A lot of folks there just dealing with a lot of rent relief and handling and that portfolio, right? Different people managing, kind of moving maybe more into asset management. And so with that, I think that, you're continuing to see the privates, as Alan alluded to, amongst all those deals, there was, only, there was only one deal that was financed, right? So there's a lot of still high net worth private individuals where we're fortunate collectively, right, in this panel of the fixed income alternative. I kind of look at that, right? The assets we sell, a lot of these high net worth groups, high net worth individuals have a pretty healthy stock or bond portfolio, right? We're all seeing what's going on with that. So I think you're going to continue to see more capital move in. And I think we've also, just discussed a little bit. I mean, you look at, these drugstores, last week we sold a CVS deal, 20-year extended deal, and it traded at a 5.5 cap. Well, you look at that corporate guarantee, as you kind of call that a bond wrapped in real estate. You look at what their corporate bonds are trading at, Chris, you just alluded to. You see these yields and you're saying, well, that's a pretty healthy yield, all things considered, what my alternatives are looking like. So I think you're going to continue to see more capital, even maybe more, capital that might not have been in our space in the past, understanding the space a little bit more, understanding that, look, this is a financing instrument. This is a credit oriented, this is a commodity, this is a credit, this is a 20-year bond that I can get at a 5-6 and grow it over what I've been experiencing for the time in the market. So I think so far we've definitely seen a continued, increase in activity of privates, and then also 1031 capital that's in the market. We have another, call it 4 CVSs under contract. All that's 1031 exchange driven properties. I think the interesting thing though to watch, and that we're going to need to watch, is when as the net lease REITs will need to be, repricing assets and what their cost of capital looks like, and the amount of acquisitions that go on in that space year after year of volume that happens, and where they come back into the market at, and where 1031 capital will be, and also just private high net worth that might not be in an exchange. Will there be a bifurcation, of where they may be and where 1031 market is? Because as we've all talked about on this call so far, the essentials.
Let me ask you a question. I want to ask you a question and everybody a question. The one thing when I got into net lease with, Keith, I know Keith was in there about the same time when I got in, 95, and Alan, was, pharmacies, there was no Amazon. I think the biggest thing that has really affected the pharmacies is this whole idea that the pharmacies could get disrupted by Amazon. Do you think that people are thinking twice now, kind of like they're thinking, hey, we should have some manufacturing here in America? Why is all our manufacturing of our stuff happening in China? We should have had, as far as masks, all the medical things. Do you think that there could be also an issue if we're buying all our stuff online, if the computers, there's an emergency, a war or whatever, and the computers break down and you can't get anything? That's only the argument I would say for really, pharmacies are almost an essential thing. And if you start to, will there be a different value maybe in the future for street retail? Or do you think it's still going to go the way of Amazon? Do you think Amazon will get bigger, pharmacies will be less? I think that's the big question in most investors' minds as far as the pharmacies. Does anybody want to take that one? Jesse? Okay, Jesse, you're on.
Matt, did you have something to put in there?
No. You're good. I can hand it off.
I just said, personally seeing Amazon hit a wall recently. I've been buying a lot prior to the quarantine in terms of just day-to-day goods, and then post quarantine. And what I noticed is I started canceling more of my orders recently, more and more, because they're not capable of filling those orders in a timely manner. They're actually hoping that the consumers go to Walgreens because they can't handle. So Amazon supply chain is overflowed with things like toilet paper and disinfectant. So what you are seeing, maybe by circumstance of that event occurring currently, is people are not relying on Amazon, and they are going to those local smaller stores like the Walgreens, like the Rite Aid, like the CVS, and that's a reliable way. Plus, they don't have to go into the store; they can drive through, which is preferable. So I do think that, and
That's kind of what I was.
having been cold calling owners of drugstores leading up to, people were more willing to sell at that point. They're like, wow, we got to get, the perception was they want to dump, higher perception wanted to dump than wanted to hold than I had seen in the past. The shift, as soon as folks started to see the supply chain lock up, those owners were like, I'm going to hold on. We've got to wait, because I think that values, perceived values are much higher now.
That's what I'm thinking. I think, the American people, what they value, if you guys have probably heard this, Matt, you probably heard this, is it's going to change. It's going to completely change. And people's value, just like manufacturing, we have to have our independence. We can't be depending on all these different countries for our stuff, because one, we're at the mercy, and two, it puts us in a bad position. Our national security depends on being independent, really. But go ahead, Matt.
No, I was just going to say, Jesse, great points. And I think the thing that I love about our space too, the ever-evolving net lease space we live and breathe, is, things constantly are changing and evolving. But, you bring up a great point about like these drugstores. And I think about, okay, so we have a 10-week-old newborn at home. My wife has literally done Amazon like day in and day out. I just open up the front door and everything's just right there. Now, once, we get through this and we go out, yes, I'll be going to Walgreens, but do I think about like my parents? And we're doing Zoom meetings, for example, like my family to connect once a week, and it took them a few weeks to even get going on Zoom. How do I open this thing up? And why I said Zoom is I'd say the same thing for them in Amazon, right? And like, Matt, how do I make this order? My parents are in their 70s, love them dearly, they're healthy, but it's just that type of generation, right? We're constantly looking at the different generations and who are our clients, who are our parents, who do we, do life with, right? So I think that just echoed Jesse's point that it's never going to go away. I think things just constantly are evolving in our space.
Go ahead, Keith.
Matt, I resemble that comment.
What's that?
I said I resemble that comment. I just, learned how to use Zoom, and as you can tell, this is new to me. But during the lockdown and the stay-at-home order, I've learned a lot of new things. My firm is now working remotely, and that had never happened before. But we got set up so that our staff can be working out of their homes, and we're doing okay with it, right? Where I would have not thought that could have ever happened 6 months ago or a year ago, and I think maybe they'll continue to do that a bit once things change. We get back to post coronavirus, which we all hope happens sooner than later. So yeah, I believe things have changed for sure. I still don't like buying things on Amazon. I still like going to the stores. But you know what? If I had twin boys about 20 years ago, and boy, it would have been nice to have someone drop off all of the things they needed at the front door, and I think would have made life a lot easier. So congratulations on that.
Carly?
One thing I was going to say, I think it's important to watch the tenant and the company's evolution, not just the consumer's evolution. So CVS and Walgreens are very adaptable. I've noticed that to Jesse's point, as Amazon is dropping the ball on shipping, which was really their stronghold, the 2-day shipping, CVS and Walgreens are picking it up. So they're doing same-day prescription deliveries, and now you can add on your basket of goods to that order. So it used to be just traditional shipping from both chains, but now you can get basically anything that they have in stock delivered to you very quickly, much quicker than Amazon in some markets. So I think the tenants that will continue to do well, of course, have to do with what sector they're in, but also have to do with their willingness to adapt quickly to whatever change we're seeing. Right now it's a pandemic. Maybe it'll be, changing consumer preference and use of space next month. Who knows what it'll be exactly, as we've seen. There's a lot of curveballs, but it's that company's number one strength, strong balance sheet, credit to weather whatever this next storm is, and then their willingness to change, which I think those two companies in particular, and Rite Aid's catching up to a bit. So their willingness to adapt will keep them strong as well.
I think that what would be a big positive for our industry is getting a lot of stability, so you limit your uncertainty. And that's our big problem right now. We have a lot of uncertainty. We don't know what's going to happen. Is there going to be a second wave? And maybe our policies set us up for this? And is there policies that we can do in the government that sets us up for more stability and more certainty? So when a developer goes out and says, this thing's going to take me 3 years to build this Walgreens store, I kind of know what's going to happen. It's kind of like going out on a boat, right? You don't want to go out and there's a hurricane. You want to know when you're going out on your boat that it's going to be calm seas. And the government can engineer that. We just haven't really thought of a lot of these things could happen. That's my only point. And maybe it's just what you value. Personally, I think that people will value stores more than they used to. People will want reliability. They're going to want something that's reliable. And I think people will be more safe. They'll want to save. They'll want to buy Net Lease so that they don't have to depend on the government. They want to be independent. That's what America was built on: independence, saving your money, working hard. Those were the main things, and a lot of people have lost sight of that. So moving along here, Keith just gave us his outlook. Alan, number 6. Alan, so what's going to happen with the 1031 market? What do you think? I heard it's delayed into the future. Is that, what are you seeing?
Well, I think the biggest question, we all have deals that we're working on now and properties under contract. And most of those are what I call BC, before coronavirus deals, where a seller had the property under contract and maybe it's just closing now or it closed a few weeks ago, and we're doing the 1031 replacement properties from deals that were signed before coronavirus really was in full motion. So in order to answer the question, we have to understand what the economy will look like. Can somebody sell their apartment building, their shopping center, their office building in order to 1031 out of their old property and then enter triple net for their replacement property? So the PPP, the economy, there's a lot of macro factors that are going to determine if clients can sell their current property in order. Usually people own, we'll call traditional property, which is not triple net. And then they say, I'm tired of management, I'm tired of maintenance. So they want to get out of their apartment building or shopping center, whatever their non-triple net. And they want passive income and a long-term lease and stability that comes from triple net property. So they want to get out of the old and into the new. I think there'll be a lot of demand for the new, meaning the triple net, because we're the solution. They need to be able to get out of the problem. So that's, I think, the key to this puzzle for how much traction the net lease world has, is how likely owners of non-triple net property will be and how successful they'll be in selling their current property. Because when it sells, I think there'll be a mad rush to triple net property, the good stuff. I used to describe the new retail, meaning not the Sears and not the Kmart and not the big box. And I used to describe my clients old retail versus new retail. I think we might, in a month or 2 months, all have a new definition of what the new retail is. Meaning, does your restaurant have a drive-through? Can Amazon replace you or not replace you? I think the new definition of what essential and what will have longevity in the triple net arena, that'll change. And I think there'll be incredible demand from owners of non-triple net property that will want that essential triple net property. But the key is, can they sell their old property?
So let me back you up, Alan. Alan, and this is for everybody, because I know everybody's going to want to chime in. You guys are all doing sales. I do mostly financing. How are you guys going to, now Alan represents buyers. I think Jesse, Carly, Matt, and Keith, and Michael represent sellers. How would you guys deal with these? Now, are you going to invite them to your office? Do you like to meet them in person? Will they be 6 feet away from you? You'll be in your desk. Will you do online meetings? Let's start out with Alan really quick because we're running short on time, Alan. How are you going to meet with your clients? Also, throw in, how are you going to attend events? Will it be online? Will there be an ICSC? Go ahead. Try to keep it short too.
I've met less than 5% of my clients. I've met less than 5% of my clients. I don't think it'll affect me. But one of my clients during coronavirus, who I've known for 10 years, asked to FaceTime because she needed some interaction with another human being. So for the first time, she asked to FaceTime. But I never meet with clients. Less than 5% of clients I meet with.
So everything's over the phone pretty much overnight and email. Okay. Michael Lynn.
Sure. So since I focus on an area of the Inland Empire, so most of my contacts I try to do it in person. So this has affected it in that I'm not asking for meetings, but just trying to stay in touch on the phone and whatever the client's comfortable with. I'm not opposed if someone does want to meet on site. I mean, obviously we're not going to meet at Starbucks or at their house, but I've got a meeting later this week. The owner wanted to meet on site. I've never met him before. Show up with my face mask and just don't get too close and just have to adapt to what they're looking for.
Jesse Limon.
Mike, are you going to shake hands?
No, I think everyone I've met in the past couple of months has just been like a Air 5.
One of these.
Oh,
you don't want to spend our terms. For
so
sure.
I'm a cold caller, so I don't meet people unless it's ICSC, and that'll be an interesting scenario. Hoping maybe virtual reality can help us there.
I hope that they're going to have ICSC San Diego in October. Let's hope that and that's right when we would know if there's a second wave, which is kind of scary, but we'll see what happens. Carly, what's your viewpoint on how you're going to meet with people and how you're going to interact in the future?
Our clients, both buyers and sellers, are spread out all over the country, so we're very used to using technology to meet. And it'll be up to the client. If they want to do video calls, we want to do remote presentations, we're comfortable doing that and have already been doing it. We do a ton of conference calls as it is. I think networking gets a little tricky. To Jesse's point, we're extremely active in ICSC, so maybe we have virtual meetings at scheduled times for conferences. I do hope that opens back up in the fall because it is nice to actually meet people in person. I think it's a quicker way to build a relationship. But if that doesn't work, I'm very comfortable continuing our business over the phone because that's very much what we've been doing in the past anyway.
So thank you, Carly. Keith Sturm is a very social person. I've seen Keith I've seen all you guys at ICSC, but I know I've had beer and drinks with Keith at the Encore before ICSC. He's a very warm and personable person. And I think that's why you and Dad have gotten a lot of listings. You're
Chris,
warm person. What are you going to do?
Well, there's nothing better than celebrating a closing over a nice bottle of wine. And I can't wait to get back to that time. And let's hope it comes sooner than later.
And Matt Berres. Now, Matt Berres, I don't know if you guys know, is a professional golfer. And he's the guy that you want in your cart when you're at ICSC because you're going to win, so you're going to get some listings. How about you, Matt? What's your feeling on this subject?
Yeah, I mean, like Carly, I run a national practice, so I have clients kind of all over the country. So, travel bans are tough. I will say, I mean, the timing of this to see my little, boy, 10 weeks old, and be home with him and have some pretty high quality family time and a little daughter. I will say the next time I go out for an ICSC or something, my wife's already got me, ready to go here with, the mask. So, but no, I think that, yeah, I think that it's, we're fortunate, I think collectively in the space that we're in, that our business does not stop in events like this. I think that's the very, very fortunate. I think we all can agree on that. And that a lot of the stuff that we do can be done via email and conference calls and very, very thankful for that. So this too shall pass, and let's hope it's sooner than later for sure. But until then, we all stay safe and healthy.
So I want to thank all you guys. It's been about 1 hour. We were trying to keep it to 1 hour. And I just wanted to say it's great to have you guys. I feel like you guys are my friends. You know, not only are we business associates, but it's awesome to know all you guys and that you guys pulled together. It shows that you care and that you're not just saying, oh, you know, I'm defeated. I'm not going to get on. I'm not going to do videos. It's awesome. And I wish you guys all the best luck. I know we're going to get through this. Hopefully we can do another one of these, but we ought to like make it a goal to do one of these again, maybe in a month, just to, you know, again, trade notes and stay active. But you guys are great. I enjoy talking to you, hearing all your viewpoints. And thank you again for helping me out with this Net Lease TV interview in this pretty tough time. But I know it's going to be great for everybody. We're going to continue to do deals, and we'll get through this. But thank you so much, and we'll see you guys all soon. Thank you. anybody else has anything to say, but